Well, good morning and welcome to the Reserve Bank. With me, I've got John McDermott, who you're all very familiar with, who's the Chief Economist and the Assistant Governor. It's great to have the students here from Kristen School in Auckland. They were the winners of this year's Monetary Policy Challenge amongst 52 schools, so congratulations. It's great to see you here. So let me just summarise the statement. The Reserve Bank today left the official cash rate unchanged at 1.75%. Global economic growth has become more broad-based in recent quarters. However, inflation and wage outcomes remain subdued across the advanced economies, and challenges remain with ongoing surplus capacity. Monetary policy is expected to remain stimulatory in the advanced economies, but less so going forward. The trade-weighted exchange rate has increased since the May statement, partly in response to a weaker US dollar. A lower New Zealand dollar is needed to increase tradables inflation and help deliver more balanced growth. GDP in the March quarter was lower than expected, but is expected to improve going forward, supported by accommodative monetary policy, strong population growth, and elevated terms of trade, and the fiscal stimulus outlined in Budget 2017. The moderation in house prices is expected to persist, although there remains a risk of resurgence in prices given continued strong population growth and resource constraints in the construction sector. Headline inflation is likely to decline in coming quarters as the effect of higher fuel and food prices dissipates. The outlook for tradables inflation remains weak. Non-tradables inflation remains moderate, but is expected to increase gradually as capacity pressures increase, bringing headline inflation to the midpoint of the target range over the medium term. Longer-term inflation expectations remain well anchored at around 2%. Monetary policy will remain accommodative for a considerable period. Numerous uncertainties remain, and policy may need to adjust accordingly. So thanks very much. We're happy to take your questions.
Morning, Graham. Just reading the box B on page 23, it's about different price setting behaviour amongst firms, it looks like. Mm-hmm. And there's a part that the implication suggests that the stance of monetary policy needs to be more accommodative than otherwise. Is that you guys sort of taking the foot off the accelerator even more in terms of that neutral stance? So effectively a bit more bearish?
Well, let me get John to talk on the technical point, and then I'll make some general comments about the inflation pressures and just what we're seeing out there. So did you want to comment on box B, John?
You're referring to your question as, it clearly has implications for policy. I don't think the way you were indicating. So the box is trying to send a message that we've been doing a lot of work trying to understand why inflation has been particularly low in New Zealand. And actually it's also true globally. And it's on some of the avenue of research has not been towards resource utilisation. That seems to be the same. It is more so that inflation expectations have been more important in the inflation dynamics. And particularly people are thinking about what's just happened to inflation more so than what they think will happen in the future. And that's been a strong finding from a number of analytical pieces the bank has put out. And because of that, and because inflation has stayed low, it's had a much more lingering impact on our forecasts. And so that past low inflation is needed to understand why inflation has continued to be very low. And because of that, you need monetary policy to be more stimulatory to compensate for that change of price setting behavior.
So if you look at some of the modelling we've done on Phillips curve equations in terms of goodness of fit, what we tend to find is that it's past inflation that determines or has a significant impact on wage outcomes rather than the forward-looking inflation expectations. So we put less weight now on the 2-year and 1-year forward-looking expectations than we have in the past. But
and I suppose this is where you get into more qualitative stuff almost, but given that's a shift, and given that it's happened in response to recent events, are you doing any work on when that might shift to a more forward-looking attitude by people in the economy, if I can put it that way? Because that would seem to me to be, if you're expecting inflation to head back towards the middle band, you'd be wanting to do that.
I mean, we look at it very, very closely in terms of, wage outcomes. But look, what we've got here is, I think, a number of structural factors globally that are weighing on inflation and have for some time. And it's always going to be a challenge in trying to assess the growth in the economy and the growth potential of the economy, and therefore the output gap that might appear at any time. And to what extent that creates inflation pressures versus the sort of the more structural elements of inflation that are out there. And some of those are very powerful. I mean, you see it in terms of the ongoing decline in the cost of technology and capital goods. If you look at import prices over a long period in New Zealand, they've had a downward trend. We're seeing much greater competition in the non-tradable space in terms of a lot of what we thought was non-tradables inflation or industries are now much more tradable in terms of globalisation. And you see that in the education sector, you see it in the health sector, you see it in construction, you see it in retailing. We've seen a technological revolution in the oil and gas sector. And there's a lot of writing now about the gig economy that many people are familiar with. So there are all sorts of structural trends, I think, out there that are very important. And we're also seeing a lot of factors, I think, that are affecting wage moderation as well, that are structural in nature. I mean, you see it in terms of the offshoring and the technological displacement that's occurring. You could argue that employer bargaining power has declined and that with less unionisation, people are making trade-offs for job security versus wage outcomes. You see it in the demographics and the labour force as well, an ageing labour force, higher paid workers being displaced by workers that are paid less. So you're seeing those sorts of structural trends. You're seeing governments with austerity plans around the world that have cut back on public sector employment and cut back on the benefits. And you're seeing measures, I think, of underemployment in many economies that differ from measures of official rates of unemployment. In other words, underemployment much higher than the official rates of unemployment. So, there's a whole range of structural factors out there. They've been with us for a long time, but it does mean that we face pressures in terms of tradables inflation, which has been negative by and large for most of the last 5 years, and you're seeing a whole lot of challenges around the non-tradables inflation sector that are to some extent structural in nature and have global dimensions to them. So that's what we're fighting at all times on the monetary policy front. You're trying to look at the output gap in the economy and what sort of inflation pressures might be building up because of the cyclical state of the economy, but you're also trying to weigh up the impact of these global trends and these structural factors.
Can you just expand on your comments on the gig economy? I mean, certainly some more political commentators blamed low wage growth on quite strong net migration, but is it possible that changes to work patterns are having, I don't know, as much of an impact in keeping wage inflation low?
Well, I think they are, and I think business models are changing. You see that in the retail sector, you see it in the transport sector, in terms of taxi services, for example. You see it in the hotel sector, and with outsourcing and I guess the compartmentalisation of services and contracting in these business models. You basically can contract on the spot market for a lot of services that'll involve part-time employment for the individuals concerned, maybe multiple employers, and that has an effect on competition and that sort of particle model, if you like, of business operations, and that drives wage moderation. And I think that's quite significant.
So therefore, if net migration was to fall to more historic levels, we couldn't infer from that will suddenly see wage inflation return to more historic norms.
Well, I wasn't really talking about migration when I was saying that. I was talking about business models and global patterns that are there. I mean, what you've seen with the migration flows here, if you look at net permanent long-term migration of working age people, that's been a large cycle. That's been 220,000 people since the beginning of 2012. That's about 6% increase in the working age population. Now, that's an enormous shift in the supply curve of labour. So if you shift the supply curve out to the right, even though you have very strong employment growth, which has averaged around 3% a year for the past 5 years, roughly around 3%, then that's one factor that will cause wage moderation. You just won't see the sorts of wage pressures that you would expect to see if you hadn't had that large shift in the supply curve. Did you want to add anything, John?
Well, just probably stressing some of the points with net migration, it has both a demand and supply side effect on the economy. So while there's been a massive increase in the supply of labour, those extra people also demand goods and services, which creates a demand for labour. So while we think it's had, a sort of a small net impact, these other factors, including productivity gains, which has been very low, technological changes, are probably having a bigger impact on the wage story than the net migration story.
Hi there. In your statement, you talked about how non-tradable inflation is moderate but could gradually increase. And obviously there was softer than expected inflation data in the second quarter. I'm just wondering what pressures you're seeing to make you sort of say that in the statement. And yeah, that's it. Thanks.
Yeah, we're forecasting output growth or GDP growth of roughly 3.25% to 3.5% a year for the next couple of years. And we think potential output growth is growing at around 2.8%. So that means that we'll start to open a positive output gap, and as that starts to open, then inflation pressures will start to rise. So that's what lies behind the increase in non-tradables inflation.
Can you just take us through your thoughts on the housing market and how that might have changed since May? You still seem to think that there is a risk that house prices take off again potentially after the election?
Yeah, if you look at national house price inflation at the end of June, I think it's running at 2.8%. From memory, Auckland is falling about 0.5% to 1% on an annual basis. And I think the rest of the country outside of Auckland is around 9%, but falling. So The risk, I think, is that house price inflation could pick up again. We're clearly not sure about that. We're pleased to see the deceleration that's occurred. But if you look at the strength of the migration flows, which continue to surprise us because we'd been forecasting that they would start to fall away, they're continuing, and also mortgage rates remain low. And we did see house price inflation start to fall quite significantly before the last election, and then it picked up afterwards. So that's always possible. But we are also seeing the banks tighten up pretty significantly in terms of their credit lending decisions. So we're pleased, as I say, to see the house price inflation falling. We're continuing to forecast that it will moderate further, but there is an upside risk. Did you want to add anything, John? No.
Governor, could you explain why you've left the OCR track unchanged from the last monetary policy statement when you've also forecast a lower inflation rate in 2018, under 1%, and you've also forecast that the output gap is down to 0.4 from 0.7. I'm just trying to understand, why wouldn't you signal an easier track when it appears that inflation pressures are lower and there's more capacity in the economy?
Yeah, we're weighing up a number of sort of offsetting forces here when we're looking at that track. I mean, if you look at the forces that will create some downward pressure on the OCR, if you look at those, for example, then you'd say, well, the TWI is up. It was up 5% until a week or two back. It's come back to about 2%, 2.5% above where it was in May prior to the MPS. We saw the weak CPI outcome in June, which was flat at 0, and we saw weaker GDP for the last couple of quarters and a weaker housing market. So all those things would say, okay, then that's creating downward pressure in terms of our thinking on the OCR. The things that are offsetting that, one, if you look globally, global growth is starting to broaden, if you like. You're seeing stronger growth in Europe, particularly the euro area. China's held up better than what people thought. It's been growing at around 7%. And the US has come back in the last quarter. Migration has been stronger, net migration, stronger than what we were forecasting. In terms of trade, at a 40-year high, they've continued to increase. And you've got fiscal stimulus there in the 2017 budget in terms of tax and benefit adjustments. So that's on the other side, and you're sort of trying to weigh up as you think about the path of the economy and the output gaps and what's happening to tradables inflation. Do you think that an OCR adjustment is required? And we're still very much in the neutral stage where for the foreseeable future we don't see the OCR increasing.
Governor, this is your last monetary policy statement. Do you think you've achieved the inflation targets that you agreed when you came in?
Bernard, I'll comment on that in a speech that I'll put together, and I'll address some of those issues. If you look at core inflation, for example, it's averaged around 1.5% over that period, over the last 5 years or so. It hasn't been outside the band, but that's core inflation. But look, I'll comment on those things at the subsequent speech.
Whoever your successor is, and I don't know if you do a briefing to your incoming to your replacement, what would you be telling him or her to worry about? And I suppose how would it be different to the worries you had when you came in 5 years ago?
Yeah, Rob, I'll cover that in the speech that I'll write. Promise to do that. But I do know who's acting, and that's Grant, who will do, I think, a superb job. We work very closely on the governing committee, all the governors consult, and as I say, work very closely with each other, and Grant's heavily involved in all these decisions, as is Jeff and John.
Governor, 3 questions. Do you think some of your critics have been fair in your approach to monetary policy? And perhaps, second question, have the more ardent ever caused your judgment to be clouded during your policy decisions? And third, also, your response to specifically Stephen Topless, do you think that has chilled the commentary from the economists in the banks?
Well, I've got nothing to say about the last one. And the other 2, the other sorts of issues I'll cover in my speech.
Hi, the consultation for the DTIs is coming up. I think they have till August 18th. Given the house price moderation, do you think that's something that you will be adding to your toolkit before the end of the year?
Well, I think that'll be for Grant to discuss with the incoming finance minister. I mean, if you look at house price inflation, we're pleased to see the deceleration. To see house price inflation running at 2.8% is a big improvement on the 15% nationwide that it was running at. But if you look at the DTIs, if you look at bank lending over the last 2 years, and you look at it in terms of owner-occupiers, or first-home buyers, that lending has been at increasing DTI ratios. It's fallen in terms of DTI ratios for investors, and that's partly in response to the investor LVRs. But for the other groups, you're seeing the DTIs increasing, even though house price inflation is moderating.
So that means that you think that they should adopt it should add it to the arsenal by the end of the year? Or?
Well, I think that's up to the discussions that Grant will have with the finance minister.
Governor, this is a bit of a longer-term question. Over the last 5 or 10 years, central banks and bank regulators have progressively increased the capital requirements for banks and are likely to keep doing that over the next couple of years, including on both sides of the Tasman. Are you taking, or is the bank taking into account the potential longer-term impacts on monetary policy of a banking sector that isn't able to lend as fast or leverage as much as it would have pre-GFC? Do
you want to comment on that, Grant?
On the capital review, I would say that it's essentially prudential issues that drive that review and that will drive our recommendations on capital adequacy if there are any changes in the ratios. Monetary policy considerations won't be a factor. If there is some change, I mean, there may be some short-term impact on banks' balance sheets and credits, but long term, I would say we would not expect it to have any lasting effect.
I mean, if banks have to hold structurally more capital than they had 10 years or so ago, doesn't that necessarily mean that they're not able to grow lending as fast or as cheaply? And wouldn't that necessarily make economic growth or change the workings of monetary policy?
I don't think there's any real evidence to suggest that the gearing of the banking sector, say across different countries, will affect the rates of growth of those balance sheets. It affects the composition of the funding between debt and equity, but the growth rate can still be as it was before. Now, you're right, it may affect the overall cost of capital if equity is deemed to be more expensive than debt. So that may have some impact on cost of funds and I would say a short-term impact on interest rates. But when we've looked at this before, that's been a pretty small effect. In other words, a marginal change in the capital ratio is not going to have a big effect on the overall cost of funds for the banks.
Just one final question from me to the Governor. You may cover this off in your speech, but what has surprised you about how our economy and the global economy has worked over the last 5 years?
I am covering that in the speech, believe me. Yeah.
It might be covered in the speech. But for those of us who probably think it could be the last time that we see you, do you think you've been sufficiently open with the media? I've had numerous interview requests turned down. Other people in this room, I believe, have too. As far as I know, you haven't given a single live broadcast or radio interview in 5 years. Is that appropriate?
Well, there's several things going on there. This will be the 30th press conference I've given. I think I'm pretty open in terms of answering questions. The press conferences tend to go to the questions dry up. The press are present at the Finance and Expenditure Committee. There's been over 30 of those. We share the interviews around. We're a governing committee. We're not an institution that's driven by one person. The governing committee are constantly giving interviews. There's probably about 8 of them today. And I believe I gave a number of interviews to your predecessor.
Hi, the New Zealand dollar is up quite a bit at the moment. I think up 6% this year, and it's been particularly strong the past 3 months. How worried or concerned are you about that, and where would you prefer to see the Kiwi?
Well, we've said consistently that a lower exchange rate would help to reduce tradables inflation. And it would also help to give better balance to the growth dynamics in the economy. And we've included that comment in this statement as well. One of the reasons why the exchange rate is strong has been the weakness in the US dollar. I think in the effective terms, it's probably, at around a 16-month low. You're seeing weakness in sterling that's linked to Brexit. And while the current real exchange rate would probably stabilise external debt at around 55% of GDP or thereabouts, then that's still too high a ratio in terms of external indebtedness relative to output. That's not only our view, it's a view shared by the IMF and the rating agencies.
Governor, just on the currency at its levels and its persistent strength, is it triggering any of the lights on your traffic light system?
Look, we do monitor the traffic light system very closely, each of the 4 traffic lights. Look, I won't comment on whether it's affecting those or not. But we do monitor those regularly, and indeed with every OCR decision, we'll sit down and go through those indicators and what the models are showing.
Governor, is the bank looking at how it models the economy, given consistently inflation has been lower than you expected and the productive capacity of the economy has been larger than you expected? And there seems to be some structural forces at work overseas. Are you having, or is the bank having a closer look at how it models the economy?
Well, we're always looking at the various models that we have and testing a number of the equations. But John, let me hand over to you.
Yeah, it's pretty much at the heart of what we do. We're constantly updating our models, and it's highlighted in our statement of intent, the direction and focus of where we are, particularly at the moment. It's, inflation. Inflation has been very low. It's been low around the world, and we've been looking at key reasons for that and adjusting the models as we go. A lot of the work has also been on what's the new normal, what's the underlying trends that have been reset after the global financial crisis. And you might have seen, I made a few remarks of that a few weeks ago, referring to what's the neutral interest rate, which seems to be continuing to decline. Today we think it's around 3.5%. Where's core inflation and what models do we use to sort of measure that? And where's the potential of this economy? So those have been the key areas of focus. And we've put out a range of research publications on that, and we'll continue to do so.
Hi. How much of a risk do you see the growing standoff between North Korea and the Trump administration, and in terms of risk, and what kind of impact do you think we could see on the currency market as a result? Thanks.
You've seen measures of financial market volatility be very low for quite some time. In fact, the VIX has been close to a two-decade low on some of the calculations that I've seen, and that suggests that that investors still have a lot of confidence in their belief that central banks are going to run accommodative monetary policy for a long time. And so you're seeing bond rates at very low levels. You've seen the compression in spreads, in credit spreads. You've seen reduction in term premiums, and you're now seeing equity markets at historic highs. And it's interesting if you look at the South Korean market, for example. Look at the South Korean equity market. It reached a historic high in July. Now, given what's happening with Pyongyang and Washington D.C., some people might think that's surprising, but it's part of a global phenomenon where basically investors are convinced that central banks will continue to have accommodative monetary policy for a long time. And that's one of the risks, I think, around the global outlook. If you look at global debt as a share of global GDP and you take out bank debt, it's running roughly at around 220%. Now that's up from 180% in 2007, or just prior to the GFC. Now, whether those asset values that are out there in terms of equity markets and bond markets are realistic will depend very much on the outlook for future inflation and what central banks do in respect of the inflation outlook. So, for example, if hypothetically the markets are wrong in terms of tightening of monetary policy, and monetary policy tightened globally more quickly, then you would see adjustments in asset prices that would be very significant, or could be very significant, and then you look at the amount of debt that's underpinning those investments, and that creates a real risk for the global economy. If, on the other hand, global inflation is going to remain weak for an awful long time, and monetary policy highly accommodating for a long time, then it's quite possible that some of those asset markets are underpriced. So the dynamic is a large increase in global debt and a lot of those valuations hangs on a view about central bank monetary policy.
Global economy?
Sorry?
So do you see North Korea as a risk to the global economy?
Well, it depends what happens there. I mean, you saw nervousness overnight in terms of equity market adjustments and some exchange rate movements. It very much depends what's happening there, what the US does, what happens with the threat that the North Korean premier has just made about Guam, what leverage China can exert on the situation and what incentives China has to act. So there's a lot of dynamics out there.
Governor, just going back to earlier when you were talking about the shift in structural changes that are becoming more important, those shifts, when does it get to the point that they then need a change to the legislative settings or sort of governing rules for the Reserve Bank? You guys have been fairly happy that it's still fit for purpose, but I mean, when do you start recognising that the things have to change?
Well, if you look at central banks around the world, there's probably about 30 of them that are flexible inflation targeters. And I know of no central bank that has abandoned that model. It's gone to price level targeting or targeting nominal income or anything like that. I haven't seen much adjustment by way of inflation targets in the last few years amongst those central banks. I'm not aware of any central bank, for example, that's raised their inflation target. And why would you when productivity globally is pretty low? Doesn't make a lot of sense. But at the same time, I haven't seen any of those central banks say we want to move to price level targeting or we're going to lower our inflation targets below 2%, because 2% seems to be a pretty common point in those inflation goals that central banks have. So if you look at where we are, we've struggled to get inflation up, headline inflation up, mainly because tradables inflation's been negative for 4.5 years. And that's probably the longest period of negative tradables inflation, would be my guess, since the Great Depression. And then there's the whole lot of structural forces underway in the global economy that's affecting non-tradables inflation that we talked about. So, we've got inflation at the moment running at 1.7 in terms of headline inflation. We think that'll come down as the petrol prices and oil and food prices start getting diluted in terms of that calculation. But we then think that with the output gap that we're forecasting, and time will tell whether we're right, but if the output gap emerges that we're forecasting, then we will see non-tradables inflation rising. Now, core inflation right throughout this period, as I say, has averaged around 1.5% and hasn't been outside the band.
Should that then become the target rather than headline CPI? Is there scope that needs sort of some of those mandated targets just to change to reflect the reality of the situation that you're operating in?
Yeah, most central banks tend to use the consumer price index and talk about headline inflation. The Americans talk about the PCE deflator, the public consumption expenditure deflator, or the private consumption expenditure deflator. The Swedes make an adjustment on house prices and things like that. But most people use headline CPI inflation. I don't know of any central bank that targets explicitly as its inflation objective core inflation, but they certainly all look at it closely, as do we.
Just with your comments on equities again, that is the case in New Zealand with the stock market at a record high. and I think the Reserve Bank's mandate is to look at all asset classes. So is that a specific worry here, that if perhaps you tweaked the OCR projections or inflation projections, then that could have quite a big impact on the stock market here?
It's not something that we spend a lot of time thinking about in that sense. I mean, the market cap relative to GDP is still relatively low in many respects. No, that's not something that we explicitly say, you know, if we raise the OCR, are we likely to have multiplier effects through the economy because of falling equity prices. But let me see if John wanted to add anything.
Not on that question, but if you don't mind, can I go back to the previous question? Because you're asking about whether we should legislate targeting core inflation. And there's one very important reason why we shouldn't do that is the current consumer price index is produced by an external agency. So we can't manipulate that. But of course, we produce a measure of core inflation. We calculate it. So it would be inappropriate for us to both target and actually produce that statistic separately. So,
You say that you should keep the CPI as your target, but then you justify the CPI being below that target by saying that core inflation is within the target band. So just looking back at the last 5 years, 0.9% CPI inflation, 1.5, 0.3, 0.4. This year, 2.2 to March, and then 0.7% next year. I mean, if you're going to justify running monetary policy that results in below target inflation by saying, look at the core inflation, why not just change the target to core inflation?
Yeah, you could, but as I say, I'm not aware of any central bank that does. Core inflation's harder for, I think, a lot of people to understand just what it is. I mean, we've got several measures of underlying inflation in terms of trim means and things like that. We've got a factor model that we put some weight on. But it would certainly be harder for people to understand at any point in time just where the inflation pressures in the economy are. But let me see if John wants to add anything.
yeah, it's probably worthwhile sort of unbundling the question, because you evaluated sort of looking back 5 years, and then mixed it with core inflation, which is really, when we're looking at core inflation, we're trying to say, where will inflation head to once you subtract or extract all the temporary factors that are playing out on headline inflation? Think about oil prices, food prices. So it gives you a sense about where inflation will head if nothing else changes. So the measure of core inflation is a tool, a very valuable tool for central banks to think about where inflation will head in the past. And you shouldn't really mix that up with evaluating what happened in the past. And when you're doing that, if you're looking backwards, you really should look over a time horizon that's sufficiently long that it encompasses a full business cycle. So I think you really need to be thinking well beyond the 5-year horizon. And if you go back, say, for example, over 10 years, which would capture a full business cycle, average inflation looking backwards would be 1.9%, so pretty close to the midpoint. If you took the 10-year average prior to the current 5-year period, you'd be looking at an average of something like 2.7. So you can see the sort of the difference that makes when you try and encompass what matters over a business cycle, not over any 1 or 2 or 3 year period.
If you look at the headline inflation over the last 5 years, for example, it's averaged around 1%. Now, non-tradables inflation, which we have quite a lot of influence over in terms of monetary policy, has averaged 2.2%. Tradables inflation has been negative for most of the 5 years, for 4.5 of the 5 years. And that's what moves the headline rate around a lot.
This really is my last question, because I don't think I'll be able to get a chance to ask you after your speech. Mm-hmm. You say that the non-tradables inflation has been the lowest since the Depression. sorry, the tradables inflation lowest since the Depression, and that the currency has been significantly higher than you expected. Doesn't that show that you've been running monetary policy too tight for most of that period?
No, I don't think so. If you look at the economy in the last 5 years, growth has averaged around 3%. That's been above trend for this economy. If you look at employment growth, it's also averaged around 3% over that period. Now, the downside of that is there's low productivity growth, or zero, or even on some measures, negative productivity growth. But you've seen output growth and employment growth above trend. And it's hard, I think, to make the argument that that's an indication of monetary policy being run too tightly, because monetary policy does affect output and employment growth. There are other factors involved in all of that, of course, in terms of population increase and construction backlogs and all of that in terms of that growth story. But you're always going to be facing trade-offs around aggregate demand growth in the economy, price pressures. You're going to be forecasting a lot of things that you find extremely difficult to forecast about commodity prices. I mean, for example, we had a 70% decline in oil prices. We had a 75% decline in whole milk powder prices. The ability to forecast those are highly difficult, to say the least. And you're also looking at asset prices when you're looking at interest rate decisions. You're also saying to yourself, well, where's the housing market? What's that going to do to house price inflation? So you're always making these sorts of trade-offs when you're thinking about monetary policy settings.
So given that, and given that inflation is beneath the band rather than above the band, would you have taken that 5 years ago if someone said, look, Graham, in 5 years' time, given what you've just said, that's going to be what the situation is at your last press conference? Would you have taken that?
Well, I think if you go back for some period, you'll find that inflation was at the high end of the band. It was around 2.9%. It had been averaging that. And that was one of the reasons why we put the emphasis on the 2% midpoint. But we also knew that monetary policy is enormously difficult to calibrate. There's judgments about lags and transmission mechanisms. And so that's why we always referred to over the medium term and on average and those sorts of concepts. But look, if you say, by and large, has the economy performed well in the last 5 years in terms of output and employment growth? Has house price inflation come down from 15% to just over 2% at this point? And is core inflation running at around 1.5%? And given that you're going to have volatility in headline inflation because of tradables inflation, then I think that's a pretty good outcome. And the central bank, can take some credit in those outcomes. It's not the whole story, far from it. There's an awful lot of other things happening. But I think the Reserve Bank has been pretty successful in many respects.
Your sort of cautious approach this year, I think, has surprised some commentators, and I'm wondering. I mean, and indeed, the data seem to have borne out and justified your stance. Wondering whether your experience earlier on in your tenure, when you raised interest rates, has that had any influence on your current sort of approach to policy? So specifically, I'm asking whether, with the benefit of hindsight, you feel that you tightened too quickly at the start of your term, and whether that's influenced your current thinking on monetary policy.
If you go back to that episode, where we did raise rates, you know, you had a situation where the terms of trade were at a 40-year high. Oil prices had been very strong in the lead up to that. They're remaining around $110 a barrel, where they'd been for the last 4 years or so. Whole milk powder prices were very high. The market was expecting a tightening. They were pricing that in. The terms of trade, as I say, were at a 40-year high. The IMF, like ourselves, was forecasting a positive output gap. And I think it was a reasonable judgment on the information that we had available and what the market was pricing and what other commentators were expecting, that we did tighten monetary policy. We tightened it 4 times. What we didn't anticipate, and I think is, you know, it's fair to say, I think that it would be very hard for central banks to forecast commodity prices. We didn't expect that the oil price would be on a downward track that would end up from $110 a barrel, that would end up at $28 a barrel in terms of Brent crude. That whole milk powder prices would go from, say, $5,200 a metric tonne to $1,590 a metric tonne at the bottom of that thing. So I think the test is, do you make appropriate decisions based on the information you have available at the time? And then if that information changes on you, do you then make appropriate decisions and modify your views? So we tightened 4 times. We then removed the tightening bias, and then we cut 7 times. So if you ask those tests, I'm comfortable that the bank meets those tests. Well, look, thanks very much indeed. As I say, there's been 30 press sessions and also about 32 with the FEC. And thanks very much for your continued interest in the bank and monetary policy. Thanks.